Okay, so our topic for today is accounting cycle. Accounting cycle is a series of recurring accounting steps or processes that span from the start to the end of a particular accounting period. The accounting cycle is composed of the following steps. Number 1, analyzing business transactions from source documents. Okay, we need to understand each transaction first. Number 2, journalizing the business. Okay, so after analyzing the transactions, we must do the recording, okay, or the journalizing of the business transaction. Next is posting journal entries to the ledger. Okay, after journal entry, we are going to post our journal entries to the ledger. Okay. Next, after the ledger, number 4, we must prepare the trial balance. Okay. After the trial balance, journalizing and posting adjusting entries. Okay, if any, there is some adjustments. Number 6, preparing adjusted trial balance. Number 7, preparing the FS or financial statements. Number 8, journalizing and posting closing journal entries. And then number 9, preparing post-closing trial balance. And number 10, journalizing and posting reversing journal entries. So we have 10 under the accounting cycle. Okay, so those are the books that we need to prepare when it comes to bookkeeping. Number 1 is journal, okay, or journalizing. Analyze first, then journalizing. Then after the journal, we have the ledger. Okay. Then after the ledger, we have the trial balance. Okay. And then we have the statement of financial position or balance sheet, the statement of income or income statement. Okay. Statement of owner's equity. Okay. Then we have the adjusted trial balance at the end, together with the cash flow. Okay, and lastly we have the financial statements. Okay, so these are the accounting cycle. Next to the accounting cycle, we have our first book, which is journalizing. This is our after analyzing, okay, the transaction, we have this journalizing. So let me read and then maximize the font. Okay, so we have journalizing transactions. This one, journalizing transactions is the process of record keeping or of keeping a record of all your business transactions, tracking them in chronological order as the transaction occur, and generally includes the date, the account you're debiting or crediting, and a brief description of the transaction that occurred. Journalizing transactions is the crucial first step in the accounting cycle. Journal entries serve as the building blocks for your financial records, so it is important to stay on top of them. All your business transactions, including payments, compliance, and purchases you make for your business, are journalized. Okay, so journalizing yung una. After identifying and measuring your business transactions, you will now move to the recording process of accounting. The first phase of recording is making the journal entries or journalizing, yung unang part, that should be recorded in the general journal or special journals, as we have studied last time, such as sales journal, purchases journal, cash receipts journal, and cash disbursements journal. A journal is a chronological listing of an entity's transactions, including the amounts, accounts that are affected, and in which direction the accounts are affected. From the journal, the entries will be posted to the designated accounts in the general ledger. The following will guide you on how to make accounting journal entries. So first we need to analyze the business transaction first before we create our journal. So what is a business transaction then? A business transaction is an economic event or condition that directly changes an entity's financial condition or directly affects its results of operations. An accounting transaction takes place when a business exchanges a thing of value for another. Examples of business transactions are when a company obtains loan from a bank, buys goods for sale, sell these goods to customers on account, and collect the cash from its sales of goods. So anything that there is an exchange of value is considered as transaction. What are debits and credits? Debits and credits form the basis of the double entry bookkeeping system. For every debit transaction, there must be a corresponding credit transaction. The principle of equality, okay, and vice versa. Every debit and credit value is initially recorded as a journal entry, and from these journal entries is then transferred to ledger accounts, and finally, these ledger accounts financial reports can then be prepared. So we have the debit and the credit. Normal balance for assets are debits. Normal balance for liability or owner's equity are credits. Debit and credit are the most fundamental concepts in accounting, representing the two sides of each individual transaction recorded in any accounting system. A debit transaction can be used to increase a debit balance in an asset account, normal balance, okay, or to reduce a credit balance in a liability account. On the other hand, a credit transaction can be used to decrease a debit balance in an asset account or to increase a credit balance in a liability account. Increase normal balance is credit, liability. So when to debit and when to credit transactions? To understand which accounts are debited or credited in order to either increase or decrease their amounts, the following 5 fundamental elements of any financial statement should be considered. First, we have assets. So what are assets? These are the resources controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. This includes cash, receivables, inventories, prepayments, investments, property, and equipment. Just like what we have studied in the previous lessons. Again, in simple terms, assets are anything that can be turned into cash into the future, or anything that can be turned into cash. Now, the second element to be considered is liabilities, which are the present obligations of the enterprise arising from past events, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. This includes accounts payable, accrued expenses, income tax payable, unearned revenue, and loans payable. Liabilities, just we have studied before, are things that could affect, okay, to the loss of our cash in the future. Okay, and then we have the third element, which is the equity or owner's equity. This is the owner's interest on the assets of the enterprise after deducting all its liabilities. The structure of equity depends on the form of a business, whether it's sole proprietorship, partnership, stock corporation, and non-stock corporation. Then to the fourth element, we have income. Income, an increase in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in an increase in equity, other than those relating to contributions from equity participants. Examples of income are rental income, sales from goods, service income, commission income, etc. Income or these are earnings, okay, of the business. Okay. Expenses, next element, are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrence of liabilities that result in decreases in equity other than those relating to distributions to equity participants. Examples of expenses are employee salaries, rent expense, supplies, taxes and licenses, or anything that will cost the company when they are operating their business is considered as expenses. Asset, liabilities, and equity are the three elements of the balance sheet or the statement of financial position that expresses the accounting equation, from where it's assets equals to liability plus equity, which must always be balanced. Income, expenses are elements that form the income statement, because if there is a greater income value, then there will be profit. When there's a greater expense value, there will be loss. Okay. The next, or the easy way to remember when to debit and when to credit an account is to remember the normal balances of the 5 types of accounts on the chart of accounts. So we should know the normal balance of assets, the normal balance of liability, the normal balance of owner's equity, the normal balance of income, and the normal balance of expenses. Normal balance of, okay, we have here, let's skip these sentences. Normal balance for asset accounts is debit. Normal balance for liability is credit. Normal balance for owner's equity is credit. For income, normal balance is credit. And for expense, normal balance is debit. When I say normal balance, okay, it will be an increase. Okay, let us say normal balance in debit. What does this mean? It means that there will be an increase in asset, so that is debit. Okay, if there is a loss, therefore, because it's not normal in assets to go, it is debit, a loss, therefore it will be credit. Okay, but if there will be an increase in asset, therefore the entry will be on the debit side. If there will be a decrease, therefore the entry will be on the credit side. So liability, if there is an increase, the entry will be on the credit side, decrease will be on the debit side. Owner's equity, when there is an increase, it will be on the credit side, and when there is a decrease, therefore it will be on the debit side. Income, increase, that will be entered on the credit side, but if there will be a decrease in income, therefore it will be credited, or it will be entered on the debit side. And last but not the least, we have expense. When there is an increase in expense, that will be debit, but otherwise there is a decrease in expense, that will be on the credit side. Okay, let's go to the next sentence. We have this one. The chart of accounts is a list of accounting accounts, of course, from companies, okay, categorized according to types of account: assets, liability, equity, income, and expenses. These 5 major accounts, okay, with their corresponding account numbers. The normal balance is what the account would have if it increases, or it increases or more than it decreases. The following are the normal balances of this account type. So we have discussed this already. The sample transactions. So for us to understand how do we debit things and how do we credit things. So the following are examples of business transactions for a single proprietorship business and their corresponding journal entries. Take note that the amount on the left side represents debit and the amount on the right side represents credit. Okay, so I have the account. This will be debit. acronym is DR, and credit on the right side, acronym is CR. Okay, so let us have the first transaction number 1. M. Santos invests 250,000 to start an internet cafe business. In the accounting cycle, first step is to analyze the business transaction. So this one, this one is considered as a business transaction because there is an exchange of value. Okay, so let us analyze first. M. Santos nag-invest. For me, what I do is tinatagalog ko muna, no, para maintindihan ko yung transaction. After kong tagalogin, sa ako inaalam kung saan ang debit tapos saan ang credit. Okay, so let's start with this. Si M. Santos ay nag-invest ng namuhunan, invest 250,000 para mampisa ng kanyang internet cafe business. So pagka nag-invest ka, ibig sabihin naglabas ka ng pera. Okay, so dahil naglabas ka ng pera, you will have yung 250,000, okay, para sa internet cafe business. At yung puhunan mo, investment mo, that will be your business, which is the internet cafe business, considered as your capital. So in the journal entry, we'll be having ano yung sa asset. Remember our accounting equation, which is cash, which is 250,000 on the debit side, okay, increasing the cash. Equivalent of the internet cafe is the cash. And then on the credit side will be the capital, M. Santos capital, which is also 250,000. So we have the asset, which is cash, and then we have the owner's equity, which is the credit. And then we have the explanation to record M. Santos initial capital. So let me explain this. Okay, for the left side, for the credit, for the debit side, yan, nakasagad po yan. Tapos we have yung account, which is cash, and then we have the value, which is 250,000 pesos. Don't forget to put the peso sign. Okay, then next we have the credit side, M. Santos comma capital, so we always put comma then capital, and then the value, which is 250,000. Remember sa credit side, okay, it will be indented, ano, at least 3 spaces or 5 spaces. Ako normally ang ginagawa ko ay 5 spaces. Kung kayo po ay naka-computer, tab lang, pwede na po. For that, that is yung second row. For the third row, pwede po ito pantay sa may debit natin o yung first row, pwede pantay or naka-indent din po katulad nito. Okay, and we always put to record, the word to record, and then yung galing sa transaction, M. Santos investment or initial capital. Kahit wag nyo nalagay yung value. Okay, next po tayo, that will be journal entry number 1. Let us have yung transaction number 2. Santos purchased 5 sets of computer equipment on credit amounting to 100,000 pesos. For the journal entry, first we analyze the transaction. Si Santos po ay bumili ng 5 set ng computer equipment on credit. Ano ba yung credit? Utang. Magkano po? 100,000 pesos. Okay? So, umutang si Santos, ano? So, nagkaroon siya ng computer equipment. So, sa journal entry number 2 natin, computer equipment, ito yung na-receive ng business. That is 100,000 pesos. Dahil hindi siya naglabas ng cash, utang po yun, accounts payable po nagkaroon. So, that is 100,000 pesos. Again, this is, ito, sa dulo, sagad po, computer equipment, then 100,000 pesos. And then, naka-indent yung second row for the credit side. Okay, so this is the debit side, yung una, yung first row, debit. Tapos po yung second row, yung ating credit. Okay, so accounts payable, indented, and then the value, which is 100,000 pesos. And the third one is yung explanation or description. Ako ginagawa ko pantay sa may first row, pero pwede nyo ring indent katulad dito. Always put the word to record first, and then yung explanation po, kunin nyo na lang po rito sa transaction mismo, para hindi na po kayo mag-isip. Okay? So, parehas lang po, no? Purchase of 5 sets of computer on account. And then, pwede na pong wala yung value. Okay po? On account or, katulad nito, sa transaction on credit. Okay po? Same thing. Okay? I hope you understood that. Next po, transaction number 3. Santos buys computer supplies for cash worth 50,000. Again, Tagalogin po natin. Si Mr. Santos po ay bumili ng computer supplies, okay, for cash. So, binili niya po iyon, nagbayad siya ng magkano? 50,000. So, ang natanggap niya po ay computer supply, ang nawala po sa kanya ng business is yung 50,000. So, natanggap, that is debit. So, we have computer supplies, okay, 50,000. At yung nawala sa business, yung pera, yung cash, which is 50,000 on credit. Okay? Explanation, to record, laging to record. Tapos, again, explanation po galing lang sa transaction natin. To record, okay, purchase of computer supplies. Kahit wala na po itong value, okay, kasi nandun na po sa debit and credit section ng ating journal. Okay, next po. Transaction number 4, I think this will be the last example. Santos pays his taxes and licenses amounting to 20,000. Again, Tagalogin natin. Nagbayad po si Santos ng tax halagang 20,000. Ba't siya nagbayad? Kasi requirement po sa isang business na magbayad ng tax. So, nawalan siya ng pera, no? 20,000. Ba't siya nawalan ng pera? Dahil sa tax. Okay, tapos, nagkaroon po siya ng expense. No? Remember yung expense, normal balance niya po ay debit. So, sa ating journal entry, ang debit side is taxes and licenses, 20,000. At nawalan tayo ng cash, decrease. So, nasa credit side siya. No? So, that will be cash, 20,000. Explanation, to record payment of taxes and licenses. That's all for now, class. Okay? So, hopefully, you study this. Ulit-ulitin nyo, no? Para maintindihan nyo po. Okay? Thank you.